Hey everybody, Real Estate Ninja here. I hope you're doing well. I want to talk about commercial real estate and the losses that banks, regional banks, are taking now, but they're going to get much worse here in the near term. Why? Because holders of commercial real estate debt, being the banks, right, know that these loans have to be refinanced soon. They were taken out 5 years ago. 4 years ago, 4.5 years ago, at much lower rates. The investors that took out those loans, some of which are companies like BlackRock. Please understand, people think that BlackRock own things. They do not. BlackRock is a fund that manages debt. And as we saw with BlackRock a little while ago, giving back their headquarters building, downtown New York, back to the bank, and then the bank had to try and sell the property and took a 50% loss, 50 cents on the dollar, because nobody wants to buy real estate at these nosebleed prices. When we're talking about commercial, this also exact same scenario will play out in the residential mortgages across the nation in the next coming years. But right now, we are in a commercial real estate crisis, one that we have never seen on this level in the history of our country. And I know for some people it's odd to think about because it's never happened. It doesn't stop the fact that it's happening. All right. Stories out of Reuters. Says U.S. regional banks seen booking more commercial property losses and seeing loan sales. Okay. Says U.S. regional banks are expected to set aside more money to cover potential commercial real estate losses and sell more property loans as the sector remains under pressure a year after the collapse of Silicon Valley Bank and Signature Bank. Now, what blows me away is the author doesn't have a really good working knowledge of what's going on. I'll give you an example of how I know this. They say regional banks are expected to set aside money to cover potential commercial real estate losses. There's no potential here. Okay, this is where people get really mixed up because they read the news from somebody that wrote it that probably couldn't finance their way out of a paper bag, let alone pay off their own vehicle. It's really how the world works. When you say that banks are setting aside money for potential losses, the banks know exactly what losses are coming. This is why I know. A bank, let's say a finance manager, really high up, a C-suite exec looks at his book of business, all the loans out, and he has a heat map. And he could tell with computer modeling how many loans he made to corporations in commercial real estate at, let's say, 4 or 5% that are now due in the next 3 to 9 months, right? That are going to need to be refinanced, and the lowest rate they can refinance them at are 9 to 11%. I'm just throwing out percentages, just numbers to give you a really good, brief overview, right? So that executive looks and goes, I know the Fed's not going to lower rates anytime soon. And I know even if they started, they'd only do little rate cuts. So all of these companies that have borrowed money from my bank that now are forced to refinance them, they are going, they're not going to be able to survive. Their margins are too compressed already. They're too small. All right. And a lot of people think, well, then the bank's just going to refinance it into another loan and just keep them the same rate. It doesn't work that way because the bank now has to borrow money to keep business going, and their margins are getting shrunk, and the cost of them borrowing money is getting more expensive. All right. So this is where people miss because the author of the news story misses it. There's no potential losses. They are happening right now. Now it says most multifamily loans are made by regional banks. So when New York Community Bank posts a surprise fourth quarter loss, it intensifies fears about the industry's exposure to commercial real estate. Multifamily properties with more than 5 units are a major concern, especially since the bank has booked losses on its real estate portfolio. Okay, here's another exciting thing that people miss. So New York Community Bank, the only reason it was in the news, because it picked up a portion of, I believe it was Signature Valley Bank, which brought its asset base or its assets under management above, what was it, $100 billion? The second that happened, there are more scrutinizing rules involved with the government, regulations with a bank that size. So then all of a sudden, everything was shown where they thought they were buying some really cool quality assets from Signature Bank for pennies on the dollar. It now exposed all the crap they were doing in the background with their commercial real estate book. Again, the reason why Signature Valley Bank went down in the first place. All right. So when we're talking about regional banks, we're talking about the ones that are under $100 billion in assets under management. They're imploding right now, and it's not in the news because the lax regulations on a smaller bank doesn't put it in the spotlight right now. It's pretty exciting knowing things before they happen, right? Type 1 if you agree. Once you see the very basic explanation that I've been giving people, that you're not going to find on the mainstream media, you start really going, oh yeah, I start to see this, right? All right, scrutiny of the regional banks has increased after Silicon Valley Bank's collapse, prompted by high borrowing costs that exceeded its income from low-rate loans following the Federal Reserve's aggressive rate hikes since March of 2022. Many banks have unrealized losses on security portfolios, including mortgage-backed paper. You stack that on with the bond, their bond losses, right? Unrealized losses. They're still, we all know, I mean, if I am an executive at a bank and I'm talking about like a C-suite, right? I'm looking at it going, oh, we're screwed. But the smaller people in the bank, they're like, they don't know because like, well, we haven't sold them yet, so it's not really a loss. And he goes, yeah, well, I got to go borrow money and my credit's going to go down because they're going to look at all of that. Hey, ducks. I love ducks. I don't know why. Like the mallard duck, your head looks awesome. I'm just saying, I just like the green head. He says a slew of regional banks report first quarter earnings starting April 16th. And I just did a video about that. PNC and some other banks, M&T, announced, and it's not looking good. All right. I expect to see more of a reserve buildup, said Stephen Brushcombe, research director at consultancy TREP. Okay, no duh, Stephen, because they have to set more money aside for the higher costs of insurance with the FDIC. What do you think about this? All you get to do is duck your head under the water and hide. Office loans have been hit as many employees still work from home after the pandemic, leaving vacancies that make it tougher for building owners to repay their mortgages. Multifamily is also under pressure, like in cities like New York and San Francisco. I'm sorry, I got to stop grinning. I'm about to do a project that is going to help so many. I'm not joking. I believe it's going to help 1 million people absolutely crush it during this next crash. I can't even tell you what it is. I get to fly to Chicago in a week or two to start this project because as everybody's failing, if you're in the know and know how to make money from it, you're going to absolutely crush it. So I'm sorry, as I'm hearing these 5 units and more market, I'm getting giddy. Several analysts and investors are predicting higher reserves. Morgan Stanley forecasts 10 to 20 basis point increase in CRE reserves ratios for regional banks this year, said Manon Gonzalez, an analyst with Wall Street Bank, in a research note. Aggregate provisions are 20% above consensus, she added. CRE holdings are significant across U.S. banking industry comprising 30% of large banks' balance sheet and 44% of regional banks. All right, so let me explain that. Regional banks have taken the burden or the brunt of the CRE loan exposure, right? Big banks are more focused on, well, depositors, but a different type of investing. Regional banks take on a lot of commercial real estate portfolios. They're going to fail. Credit unions tend to take on a heavier exposure to credit card debt, right? So different size banks, it's like they start small with credit cards, build their banking up. As they get larger, they move into commercial real estate. As they get bigger than that, they go into offshoring, the big national banks go into the overseas markets, right? Expansion like that, wealth preservation, wealth management style. So that's like the evolution of banks. Now it says S&P Global Ratings downgraded the outlook for 5 U.S. banks in March because of stress in the CRE markets, which it said may hurt their asset quality and performance. The banks cited including M&T Bank, which put out their information today, their numbers, and Valley National Bancorp declined to comment. The CRE delinquency rate for banks is more benign than the commercial mortgage-backed securities market, but it's deteriorating. This is because this is being pushed off and held back. But now that the Fed's repo window is closing even more and more and there's less money flowing out, you're going to see this come out in the next 3 to 6 months. 6 months from now, we're going to be in full-blown crisis. It's going to be way worse than the spring of 2023. The delinquency rate at regional banks is 1.2% for loans 30 days due as of the end of the fourth quarter. That this was the fourth quarter. It's going to get worse. According to S&P Global, below the 4% for CMBS. Let's do this real quick. Now, numerous community and regional banks are exploring their options as a result, and we are seeing more deal flow. Who cares? This is all crap. All right, here's the truth. There is a massive opportunity coming. Right now, I'm sitting on the sidelines with my real estate holdings, and I'm going to go big as this crash goes, and I'm going to move into commercial real estate. I've taught people this on my other courses and stuff. Right now, I'm focusing on crypto because that's the big boom over the next 3 to 5 months. If you want to be a part of it, the Crypto Trader Pro courses, the pre-filming discounts down below. It should be good for about a week and a half until we wrap up filming and editing, but right now there's stuff on there. That's where I'm putting a percentage of my portfolio right now because I see all the money flowing into crypto. I see it all flowing into gold and to silver. Then I reposition and we're going to dominate real estate. I know it sounds crazy. I love doing this because the cycles don't lie and the markets are panicking and you just haven't seen the panic yet. You'll see in the news mid-summer about how bad the banking system is. And it's going to be a great talking point for the next election. I hope you guys got something out of this. Thank you for checking out my backup channel in case something happens to the main one. If you don't mind hitting subscribe, be cool. If not, no worries. I hope you guys have an awesome day. The Ninja is out.